Hello, this is Bob Wiley with the Wiley Group of Sampson Properties, and I have a special guest today for us to talk about all the ramifications that have come out of COVID. So I'd like to introduce our guest, Brian Steinberg of Millman and Steinberg. Brian, how are you today?
Great. Thank you so much for having me. How are you?
You're very welcome. So why don't you give us a little background on yourself and Millman Steinberg?
Sure. Millman and Steinberg is a law firm based out of Pikesville, Baltimore, Maryland. We've been doing short sale negotiations as our primary specialty for the past 5 years. And my personal background before that was in customer service and corporate negotiations for several years. Combined that with two of our law partners to help facilitate homeowners out of homes they can't afford and on to the next stage of their lives.
Fantastic. So I can tell you that I have used their services, partnered up with them for several short sales, which we're going to talk about a little bit as well. And I can tell you that it's been such a pleasure working with you guys. I got to tell you one quick story. We had a woman who you're probably not going to believe this. She paid $400,000 for a property. She held it for 10 years, okay? She had an interest-only loan for all that time. So after 10 years, she still owed $400,000 on the property. It was crazy. The bank had already made many, many thousands of dollars on her, and you guys were able to get it resolved. She actually cried on my shoulder at closing because it was such a relief to her to get that done. So first, we want to talk a little bit about this past year and COVID. How has that impacted the market, Brian?
Sure. Let me. You just touched on something that's really important. So I'll get to COVID in a second. Home ownership in the U.S. is aspirational. It's always been the hallmark of the American dream of having made it. I've arrived financially. I'm a family man or person, and more than losing any other kind of item, a car, a computer, anything, there's so much emotion that's tied up into people's homes. It's where their memories are. It's where they raised their children. It's where their grandchildren visited. There's so much that's riding on this process that we know what the end result is when it's right and when it's wrong, and it can be tears both sides. We try and do this. My way back career was in nonprofit. We want to do this well. We understand what people are going through, and while we're working diligently and pushing banks as hard as we can, we're really walking people through with sensitivity, knowing what this is to them and doing it right. Partnering with agents like you, with brokerages like you who do it right, is really important for us as well. As far as COVID goes, it's really interesting. The smart money, I think last year, said that the market was going to tick down a little bit. It wasn't going to be a massive crash like in 2008 because fundamentally the market had been doing very well.
Correct.
Underlying rot like there was 12, 13 years ago. But I think what surprised a lot of us was that the smart money was wrong and the brilliant money was right, which is that the property prices really spiked 15, 20, sometimes 25%. And that's a function of interest rates dropping. That's a function of last March, January, February, March, a lot of investors cashing out of the equities markets because they weren't sure what was going to happen. And people had financially done very well over the past decade. So there was money out there to spend. Homeowners didn't want people all of a sudden walking through their properties, potentially exposing them to COVID. So what we've seen in places like Frederick County is a decrease in listings and closings, therefore, by about 50%. We're also seeing, because of mortgage forbearance, all of the people who would have had to sell their homes because they couldn't afford them now are sitting under that protection. And that was we're seeing this year a 90%, 96% decrease in foreclosure activity because of forbearance.
Forbearance, right.
Over last year. So
a lot happened. The market definitely expanded. And people have asked me, well, Bob, if there's no inventory on the market, how are there so many people, so many transactions going on? And what I've shared with them is new construction.
Yeah.
Going back to the point you made before about people didn't want strangers, buyers coming into their house. So they were afraid to put the house on the market. But then they wanted to buy a new property because many people thought, okay, now I've got to have an office for myself. I've got to have an office for my wife. I've got to have a space for either 1, 2, or 3 children to do school. We need more room than what we have now. And a lot of people went to new construction, bought new construction, didn't have to worry about going into other homes. They felt safer buying a new construction, but then they were able to sell their house. We actually made the same move. We didn't sell our house. We did keep it to rent it, but we made the same move because we were in the same position. Right. So yeah, so now you've touched on forbearance, and that really is the gist of what we're going to talk about today. But let me ask you this: what do you expect, and what are you hearing is going to happen with the real estate market now that we're starting to see the light at the end of the tunnel? I know today our numbers in Maryland got back up to 5%. But what do you see? What do you guys see coming after COVID kind of ends?
So again, smart money says the market's going to soften. Prices may not retreat to where they were pre-COVID, but they're certainly they need to tick down. Interest rates are bound to go back up. Homeowners who haven't needed to sell but have wanted to for whatever life move they've wanted to make are going to feel and are starting to feel more comfortable.
More comfortable, yeah.
That's going to bring more inventory to the market, which should drive prices down. And really the big thing is when the federal forbearance programs all expire, and we see all of those properties, or many of those properties, coming to the market either as in some pre-foreclosure action like a short sale, or the bank has taken ownership and they're auctioning the properties. We are anticipating to see a lot more inventory that should bring prices down somewhat. But again, smart money isn't always right.
Always right, are they?
Learned. So, we're in this as well, curiously keeping an eye on trends and what's happening. And what we're doing in the meantime is knowing that regardless of what happens, there are going to be people who have to make a choice of whether or not to short sell a property. So our goal right now is to get those people prepared.
Through this property. So let's talk a little bit about mortgage forbearance. What is it? Can you explain to our viewers what mortgage forbearance is and how does it impact the owner?
Sure. So market forbearance was part of the Government CARES Act passed last March. And what it said was, without really having to show any kind of proof of financial hardship as a result of COVID, if you have a federally backed loan, you can have—
And that would be VA, FHA, Freddie Mac, or Fannie Mae.
Yeah, Fannie, Freddie, HUD, FHA, USDA, and VA.
Right, okay.
So that if you had a federally backed loan from any of those houses, you could have 2 6-month forbearance periods, which means effectively you don't have to pay your mortgage without any consequence, without any penalty, fee, or without foreclosure. You were in a safe, protected zone. That was then updated. If you have Fannie Mae or Freddie Mac, you were able to get additional extensions of forbearance up to 18 months if you were in the program, I believe, by the end of February 2021.
Okay.
And if you have a HUD, FHA, USDA, and VA forbearance, you can get up to 18 months if you were in that program by, I think, June 30, 2020.
2020, okay.
Yeah.
All right.
Yeah, at the end of that period, people ask, well, what do you do? What happens with the money that you haven't paid? Well, you owe it, and you have to come up with a repayment plan, which will either be adding those months of missed payments onto the back of the mortgage, or if people want and are able to, paying some amount of increased monthly payments over the next months or a few years.
So basically, they're just reshuffling the deck, taking the amount that you owe, reallocating it over the remaining years, and you pay it all back.
Correct. Now, and that's a wonderful step the government took for homeowners.
Yeah.
Where some homeowners get a little bit frightened is that their mortgage servicers can still send them collections notices, foreclosure kind of
Paperwork.
scary notices, but the actual process they can't go through and close on until after forbearance. The one thing that we don't know is how fast banks will be to pull the trigger.
Right.
And these banks are out a lot of money. I mean, banks have done well over the last year, but when it comes to their mortgage business, their mortgage servicing businesses, they're out a lot of money. So what I anticipate is that June 30 or whenever someone's individual forbearance ends, they're going to start getting collection notices and foreclosure notices right away. That's what we anticipate.
Let me put, if you don't mind, I will put things into context a little bit for people. So, okay, so your monthly payment is principal, interest, taxes, insurance. Okay, 4 things. Everybody knows that. Now, if you're not paying that principal, interest, taxes, insurance to a lender that loaned you the money, your first thought is, well, they're only out really the interest because they've already given me the money. But the reality is, if your taxes, which they did come due in the state of Maryland, they came due in July of 2020. They also came due in December of 2020. So your servicer, because you mentioned this and I wanted to stress this, so you have a loan servicer as well as the original lender. They're paying your taxes for you. They're paying your homeowner's insurance for you, and they're also then eating the rest of that. So to put a little emphasis on what you've said, it's not that they're not getting money in, it's also that they're putting money out that they're not getting covered. So to go back to your point, yeah, they're going to be quite anxious to get this money back. Now, let me ask you this. Suppose someone does want to sell. Is there a problem paying off that loan? If they sell it, can they pay it all off?
Well, that depends on the current value of their properties.
Right, for sure.
You know, one of the benefits for at-risk homeowners over COVID is that the increase in value of their properties might mean that a year ago they would have had to do a short sale, which we will talk about in a moment. But now, if they had a 15 or 10 or 20% gap between their current property value and what they owe, a year ago they might have not been able to pay off a mortgage by selling the home, and today they might be able to.
Right, exactly. So there's some good that has come out of the increase in property values over the last year. So that should put some rest, at least peace of mind for people that are, okay, we have to sell, we need a bigger home, our family has grown, or we have a circumstance where we need to, there are a lot of employers that are saying, you know what, Brian, you can work from home.
Right.
I have a client right now, we just put their home under contract, put it under contract in just days. They're moving back to their original state because their employer said, you've done a fabulous job this entire year working from home. We want to keep that. You can live wherever you want, and you can continue doing the job that they have been doing for their employer located right here in the state of Maryland, in Baltimore County.
Yeah. Reports basically industries wide are saying that the productivity level of this past year far exceeded expectations.
What their expectations?
It's a function of many things, but it is interesting. And you're right, as you said before, people went to new homes, but people are also expanding their properties, bumping out when they can, putting in a home office or a suite. Or
they had the bump in COVID family as well.
Yeah, and
because people had so much time on their hands.
As a result,
so let's talk a little bit about short sales.
Sure.
So as I've said, I just had a gentleman yesterday who wanted to show him a property, and I said, so this is a short sale. Do you know what a short sale is? He goes, no, I just assumed that it was a shorter process to buy it.
Right.
And that's not even close, is it, Brian?
No, it's not. And I'm 6'3" and I still do short sales. It's all unrelated. So traditionally in a housing market, if you buy a property, you could bet that it was going to increase in price.
That's the American dream.
Yeah, and you would be able to sell that home some years later, pay off whatever remaining mortgage debt there is, and walk away with a little bit of cash. That's pretty much how everyone expects it to work. Unfortunately, it doesn't always work like that.
Right.
So a short sale is when the mortgage debt is greater than the current appraisal value or market value of a property, which is also known as being underwater. And in this case, the banks for the last number of years have allowed people to sell their home at what is around current market value, and they forgive the difference, which is called the deficiency amount. So
Okay.
just as an example, if you have a home value of $100,000, but you have a remaining mortgage debt of $125,000, the bank through
That difference.
yeah, that $25,000 difference is the deficiency amount. The banks will allow us now through an application process to sell the home for, let's say, $100,000, and they forgive the deficiency, which is called a deficiency waiver. What's
Okay.
important, what's very important, is not all banks' approval letters for short sales automatically include a deficiency waiver.
Okay.
So something that a negotiator has to be very particular about in reviewing the approval to make sure that verbiage is there so that deficiency is waived. The bank cannot come after you for it.
Okay, and we're going to talk about your role in that process. But first, I want to also mention, so we have the deficiency, we have the market value, and we have what your payoff value is, okay, what your payoff amount, 25,000. But Brian, people might be wondering, well, aren't there other costs involved in a closing? What about the commissions that have to be paid? What about the transfer and recordation?
Sure.
Who pays all of that amount as well?
So in a short sale, all of that is paid for. It's technically it's a seller cost. Technically, the seller's paying for it, but it's not coming out of the seller's pocket. It's coming out of the seller's side of the HUD, which is just a transaction document for the deal, but the money is being deducted from the net to the bank. So the bank is covering all of those costs.
Okay, so if we say the market value is 100, but then there's another $13,000 in fees, that money is also deducted from the amount that the lender gets at the bottom line.
Right. So what most lenders will do is give us two pieces of information if they're nice to us, which is one, what they think the market value is, and two, the net amount that they require we provide them on a contract. So they might say market value is 100,000, but because we're going to have to pay the fees out of the proceeds of the sale, we have to net 85,000. And then we know what we're working with as far as fees in the deal, and sometimes we have to figure out how to cut those expenses.
And for those out there that happen to be realtors that might be watching this, we are not allowed to negotiate with the bank as realtors. An attorney or a short sale company has to do the negotiation, which is why I always call Brian's company Millman and Steinberg. Okay, now the next question. What is your role? Okay, so I have a seller wants to sell their property, okay? And I tell them, okay, it looks like we're going to have to do a short sale. I would like you to work with Millman and Steinberg. And now, Brian, tell the audience what your role is in the process from that point forward.
Sure. So the best way to think about it is think about a conductor's role in an orchestra.
Okay.
There are several pieces, and your job is to keep them all in harmony and doing their jobs, not just individually, but in sync with each other.
Okay.
So in a short sale transaction, there's several parties. There's the buyer, there's seller, buyer's broker, seller's broker, title company, sometimes an HOA, there's the lender, and there could be numerous outside creditors. There could be state tax agencies, there could be the IRS. Our job is to coordinate all of the tasks that everybody needs to do and make sure everyone's doing them together, communicating together. And we also are the go-between in making sure all the paperwork is being done, looking over paperwork to make sure things are being done correctly. We also negotiate with outside creditors. If there are liens on a property, all liens need to be cleared in order
Right.
to close a short sale. So if you do have liens with the IRS or with Maryland for state taxes, or even a credit card, anything that might be an encumbrance on the property, we will negotiate terms for releasing those liens. Um,
Including if someone has to pay an insurance premium for for the loan, uh,
yes, yeah,
they would have to pay that off as well,
correct,
right?
correct. And
Not
there's some things that are non-negotiable.
like mortgage insurance premium is what I'm talking about,
Yeah,
because that was the one that we had before. There was a MIP that they were insisting be paid off,
right,
and our client had to take money out of her 401 to pay for this. That was a very unusual situation because
correct.
typically, I mean, considering the bank waived almost, in this case, it was about $100,000 in
Yeah,
lost amount because the value had dropped that much from when she bought it to when she sold it.
yeah,
The bank, that was a lot of money that the bank was already eating. What about multiple mortgages? What if there's a first and a second? You can handle that too.
yeah, sure. So
Okay, then.
if your purchase price is able to pay off one mortgage in full and only the second one partially, then we don't need approval for the one we're paying off in full to then
Gotcha.
make a traditional sale, and we could just do a short sale on that second mortgage that can't be paid off. If the purchase price can't pay off either in full, then we have to work with both lenders, or however many lenders there are, 3, 4, to make sure everyone gives short sale approval. We can't actually close a deal unless all banks who have either a mortgage or an equity line of credit have agreed to the sale.
Gotcha. So we talked a little bit about forbearance, and we're going to come back to that. We're going to circle back to that. So forbearance, everyone that wanted to get in it was allowed to get in it without having to prove anything at all. What about with a short sale? Would a potential homeowner that applies for a short sale, do they have to provide any information to get accepted into the program?
Sure, absolutely. So the two main requirements for a short sale, as we've already discussed, you need to be underwater. Otherwise,
Okay.
there's no transaction here. Okay. Once you have that, you also need a verifiable financial hardship.
Okay.
And that could be any number of things. It could be a loss of a job or reduction in income. It could be the
Okay.
passing of a spouse. Your elderly, sickly mother-in-law could move in, and you have medical expenses.
Gotcha.
The requirement actually for hardship condition is pretty low. It just needs to be verifiable.
Okay. There is a bar, but it's a low bar.
It's a low. Once you're
Okay.
once you're underwater, the banks are pretty flexible about what your hardship is. What they won't do is come in to bail you out with a short sale if your spending has been irresponsible. So if
Gotcha.
you're driving a Porsche and you're cruising the world, they're not coming to bail you out.
Right.
If this was an investment gone bad in a portfolio of investments that you have, they're also not looking to cover your loss. They're looking to do this for people who are truly in a financial hardship and really just need a break. That's what this is.
Gotcha. So is there, so someone may be out there thinking, well, you know what? I'm just going to let it go to foreclosure. This sounds like a lot of work. I don't want to be involved in that. I know you're not an attorney like myself, but people ask me this, but tell us what, in your experience, what have you seen? What's the benefit to doing a short sale as opposed to letting the property just go to foreclosure?
Sure. So first of all, it can be a frustrating process, but our being involved, we take that burden from the homeowners. We take the stress and we do the dirty work. So that minimizes the stress and the exposure that the homeowner has to the process. As far as the advantages of a short sale over foreclosure, there are a few of them, and they're significant. One is a mortgage. If owning a home is an aspiration you have, again, which is wonderful, with a short sale, you can get another mortgage in as little as 1 now to 3 years.
Okay.
With a foreclosure, you're still looking at a 7-year time.
7-year term. So it's a big difference. I mean, 7 years as opposed to 1 to possibly 3, depending on the lender. Some
Right.
lenders will allow after 1, some are requiring you go full 3. But yeah, that's a big difference between 7 years and 1 to 3 years.
Yeah.
And again, going back to forbearance, a person can sell that home that has been in forbearance and immediately buy another property, again, depending on the lender's requirements and their stipulations. If you ordinarily have good credit, that's going to be a consideration. If you have bad credit, well, of course, they're going to take that into consideration. So it's really a case-by-case situation. Is that correct?
Yeah, and credit's another really important thing to discuss. The impact on credit is very different. Credit is our financial reputation. It allows us to do everything from getting a mortgage to getting a car loan to getting a card, a store card at TJ Maxx.
Right.
So credit is very involved in our lives. Both a short sale and a foreclosure will impact credit.
Right.
We can't say numbers and for how long exactly because it depends on your individual credit profile.
Gotcha.
If you have a bad credit history, the impact will be greater. And if you have a generally responsible credit history, then the impact of a short sale is going to be less. Generally, what we can say is that your credit score will go down less and for a shorter period of time with a short sale than a foreclosure.
And of course, with a forbearance and a paid off forbearance, that will have no impact on their credit. According to what the federal guidelines are, forbearance is not supposed to have an impact on your credit. Again, case by case basis, always. Let me ask you this. So the application process, if we have someone that wants to do a short sale, what's the application process? Can you give us a quick highlight on that?
Absolutely. Let me just talk about a few other important differences, if I may.
Absolutely.
One is, which is really nice, is relocation assistance. In a short sale, there is an opportunity for a homeowner to walk away with a few $1,000s. On average, it's 3. Some banks will say we're going to get you up to 10, but generally we try and set the expectation that $3,000 is a reasonable amount that banks may give homeowners who currently occupy the property they're going to short sell. If you've already moved, you're not going to get that. There are 2 other things are the deficiency judgment, right? We're going to, in a short sale, there's a waiver of the deficiency. You don't owe that extra $25,000 that we discussed.
Okay.
And in a foreclosure, there will be a legal judgment for that amount against you.
Okay. All right.
That's important.
So now let's talk about that deficiency again, just for a moment, because when we came out of the recession and the bubble burst from 2007, 8, 9, the federal government allowed people to do short sales. And that money, that deficiency, so we'll go back to our example. We had a $25,000 deficiency, and let's say we had $1,500 of additional fees. So now we're essentially talking about $40,000 that the homeowner didn't have to pay. What happens to that $40,000? How does the federal government view that money?
Great question.
As of today?
Great question. That is actually brought me to the last point I had in mind for the differences between short sales.
You think alike.
Yeah, you're good. You're good. So historically, going back probably more than 7 or 8 years ago, the government considered that taxable income.
Right.
And so the government would say you had $40,000 of benefit. Okay, it was forgiven debt, but that's of real value to you.
It's unearned income, essentially.
Exactly. And we are going to tax you. Now, go tell a person who can't afford their current mortgage that they're going to have to pay $40,000 taxes on phantom income of $40,000. It's not doable for most people, and it's not reasonable. Whether it's even ethical and moral is a different question. But government came around to it, and they passed mortgage debt forgiveness, which allowed homeowners to do a short sale and that forgiven debt, that mortgage debt deficiency amount, was no longer considered taxable income.
Okay.
Here is the problem with that. The problem with that is the government passes 1 year extensions of that tax rule
Right.
every year in January, retroactive to cover the previous year.
Okay. So you never know whether it's actually going to still be the case for your deal.
There is a congresswoman out in California, Congresswoman Brownlee, who I've worked with, one of her legislative aides, on doing this to try and do it prospectively as
Yeah.
opposed to retroactively, so you know what your deal is.
Right.
They actually did it last year for the first time. It was prospective, covering everyone in 2020. With everything going on in COVID, you would have thought it would have been part of the CARE Act, but the CARES Act, it was not. So as of now, we have to wait until next January for them to retroactively pass that rule or extend
Got
that this year.
Okay. All right. What happens if the bank rejects the sale? What if they say we're not going to do it? Now, we've had transactions go months, 2, 3, 4 months. And then the bank comes back and they say, no, we're not doing it. What
Okay.
happens then?
So usually the responses to a short sale, and a great day, is yes, you could do it. If they come back and they say no, sometimes what they'll say is, well, we've qualified the homeowner. Yes, they can do a short sale, but we need more money out of the deal. So they might counter offer. They might ask you to bring up the purchase
Money
price
to the table.
or reduce fees in the deal to increase the net.
Gotcha.
They can also qualify the short sale, but if they're not convinced that the homeowner really has a compelling hardship, financial hardship, and he's got 250 in the bank and he's got a very good job, what they might say is, you're underwater, we're going to help you out. We'll do a short sale, but we want you to share the burden.
Gotcha.
And they'll ask you to sign a promissory note of X number of dollars to pay over per
So
month
many years.
for the next couple of years. That's very rare. That's very rare. And that usually we can negotiate down. But that's really a case where someone really does have the money, but they're just trying to get out of
Right. Trying to work the system.
Yeah.
Which now brings me to, so your fees. You guys certainly don't do this for free. I know I get paid through my commission from the bank, thankfully. What fees do you charge the homeowner?
Right. So we have fees that, well, I guess the nice answer is nothing, but technically that's not
That's what I was getting at.
Yeah, it sounds great, but nothing's for free, and anyone who says it is selling you something.
Right.
So all of our fees, like all of the other transaction costs of a short sale, are paid for out of the proceeds of the sale. So the bank is covering those costs.
Okay.
So we put them on the seller side of the HUD, like all of the other costs, like your fee, like your commissions, taxes, everything, but the bank is covering them.
Very good. Very good. Are there any highlights of the transaction itself? I mean, we know that, I guess the first highlight, the first important milestone is when the bank says, okay, you are eligible for a short sale.
Right.
What are the next ones after that?
One thing I'll say about short sales is that there's no rules, because the laws governing the short sale process give tremendous leeway to banks to govern the process as they see fit, and to change those standards and requirements at any time. But basically, once you have the green light to do a short sale, it might be a lot of paperwork, but it's not complicated. There's a bank application to do. Generally, they're going to ask for 30 days of pay stubs or proof of unemployment. They might ask for 1 or 2 years of tax records. If you're self-employed, a P&L. And here's this is important, because banks are numbers people. You have to write a hardship letter.
Okay.
The hardship letter doesn't have to be long. It could be 2 or 3 sentences, just explaining the nature of the hardship, when it started, and how long you think it's going to last. This is the one place in a numbers data-driven process where you can make a personal appeal to the bank. And the hardship letter has been a difference maker in getting deals approved when they were really on the cusp.
Right. And we know that there have been a lot of people, a lot of families where either the husband or the wife had to stop working because now they have children at home that they've had to, take care of for school. And this, we're not out of the trees yet. I mean, this still could go on for several months. So,
Right.
so I guess in order to wrap this up now, to keep it as short, we are going to actually encourage people to send us questions through this link when we're all done. But for right now, know that if you do have a hardship out there and you're worried about making the sale or making the payments on your home, and you want to simply investigate what your options are, we're going to provide some information. You're going to be able to contact me, and I can put you in touch with Brian and his law firm and get you guys the help you need, the questions the answers that you need, and work through the unfortunate part of this pandemic. Brian, I want to thank you very much for all the information you provided. Any last minute comments, any last minute notes that you think we missed that I didn't cover?
Most important part of this process is communication, setting expectations, everyone really understanding their roles and responsibilities, and that's what we're going to walk everybody through. On a personal level, obviously, I hope everyone out there, you and your families are safe and in good spirits, and hopefully seeing the light at the end of this tunnel. And something I always tell people that are about to engage a short sale process is the process and this stage of life that requires that you think about this now doesn't define who you are or who we are.
That's an excellent point.
And we are here to get you to your better tomorrow and to your next stage with dignity, with grace, with a smile on our face, and hopefully a relationship that will go beyond the short sale.
That's fantastic. Thank you, Brian, very much. Have a great day.
You as well. Bye-bye.